Hey, welcome back. And in today's video, we're going to talk about the fears and worries and probability of us going into a double dip recession and whether or not we have reached the lows yet. Now, we're going to start off with a clip from the All In podcast, where investor and entrepreneur Chamath Palihapitiya stated that not only does he believe there may be a double dip recession, but also a resurgence in inflation sometime within the next year. So let's start off with a quick clip of what he thinks will happen with the macroeconomic environment moving forward.
Here's this really interesting setup. We have a bunch of very positive news that I think we all have to process. First positive news was that inflation ticked down. Now, here's what I'll tell you. There's a caveat here. I talked to a bunch of pretty smart sharps on Wall Street. And, two things. Number one is they all gave credit to David Sachs, and they said Sachs was totally right. Double dip recession is coming. But then they said, tell Sachs that we think that these are the sharps. We think that there's a double hump in inflation coming, which means it's coming down to come back up. And there's a bunch of reporting vagaries that may cause that. So keep that in the back of your mind. But positive news number one is inflation ticking down.
So in this clip, he is outlining some of the main reasons that we have seen this most recent rally in the stock market. And one of those reasons, as he says, is the lower than expected inflation prints. But when he is talking about this short-term catalyst for the equity markets, he also states that a lot of the insiders that he has been talking to agree with the likes of David Sachs, one of the other members of the All In podcast. And they think not only is he right about the possibilities of a double dip recession, but also the fact that inflation may surge again and potentially even peak. Now let's see what Chamath has to say about earlier stage businesses and what they should be trying to do to survive this tough economic time.
It feels wonderful to have a few days of it's like a respite in the middle of a huge storm, right? It feels like we've been getting whipsawed back and forth, and
the sun
nice.
Came out and the wind went down.
Came out. I would just really encourage people in this moment to reset your energy, which I think is good. But you got to go back into that office and you got to find the money and the wherewithal, I think, to last through 24, if possible.
Now he and a few other of the podcast members chime in to agree with him on the idea that companies need to have the cash to operate for at least the next 2 to 3 years. Now no one knows if we will see another rise in inflation or if there will be a larger recession that comes after this brief rally. But from his perspective, he clearly states that the sentiment that he is hearing from other people within his circle that have a lot of influence and a lot of money are predicting a larger sell-off, and that companies must prepare for harder economic times ahead. Now personally, I don't have much conviction on whether or not this will or won't happen, but if I had to speculate on the markets moving forward, I would say that we could see a prolonged period of slow economic productivity where share prices could drop further or remain stagnant, especially if the Federal Reserve continues to rise rates and maintains a higher terminal rate. And I think we've begun to see this, especially among big tech, where Meta is laying off around 11,000 employees, and Amazon just announced that they are going to be laying off a large portion of their employees that are dealing with their devices. Now, although I do think there is a decent probability that this situation could play out and there could be a prolonged period of time where share prices are stagnant and potentially even falling, I have a long enough time horizon to where I'm remaining fully invested, because I think over the next 5, 10, 20 years, these price movements won't matter a whole lot. It's important, however, to take this situation and make the best of it. With prices falling, and we're seeing multi-year lows on certain equities, this may be a good time to get in at your highest conviction plays and lower your cost basis. Now, in this past week, I've been doing a lot of research into Taiwan Semiconductor, and I've decided to add it to my dividend portfolio. And the reason this came to my attention was I was doing a lot of research into Intel, AMD, Nvidia, and I kept coming back to TSMC because I kept finding how important TSMC is to all of those businesses and that they're the leader when it comes to developing advanced 5nm wafers or chips. Now, Taiwan Semiconductor makes chips for very notable companies, including all of Apple's M1 and M2 chips, as well as AMD and Nvidia's technology as well. They even make chips for cars, airplanes, and so many more devices that you can imagine. Now, when discussing this company, it's important to consider the fact that they are in Taiwan, and with China and Taiwan's tensions rising on the potential invasion of Taiwan from China. But it's important to note that they are diversifying their business into other regions across the world, from Japan to the US, where they've committed to invest over $100 billion within the next 3 years, even building factories in places like Phoenix, Arizona. Now, the reason I invested in Taiwan Semiconductor is because I don't see the semiconductor industry slowing anytime soon. And I think there will continue to be a very large and growing demand for chips as we continue to make things smarter and put them online. the demand will only grow for these products. Another reason that I think Taiwan Semiconductor could be a good investment is that they are so far ahead of the other competitors within the industry. They are one of 2 companies that is capable of making these advanced 5nm chips, but they are also building a new factory in Taiwan, which are claiming to use far less power and be significantly faster. So overall, I'm excited to add this to my dividend portfolio because I think even if they stumble and the competitors catch up a little bit and they lose market share, that they will still be ahead of a lot of the other competitors within the industry, and that they will continue to grab a significant share of the global semiconductor space. I've also been continuing to dollar cost average into positions like Microsoft around the 220s and 230s because I think they will continue to provide steady flows of cash and do very well within a recessionary period or economic downturn, because people aren't just going to get rid of their Microsoft 365 subscription, and they're not going to stop gaming and using all of Microsoft's other products and services. I also bought a little more Texas Roadhouse as they continue to hold up well within the restaurant category. But I do consider this one to be a little bit more risky because if we enter a recessionary period, people will most likely stop going out to more expensive dinners like Texas Roadhouse and other restaurants like that. And it's not sexy by any means, but I've also invested more into SCHD to further diversify my stream of dividends over time. And I have been buying a lot in my growth portfolio as well. For example, I added to my Amazon position because I think that under a $1 trillion valuation, Amazon is really just a steal. With their AWS cloud, their advertising services, their Prime subscription, and their powerhouse e-commerce business, I think the sum of all those parts is far above $1 trillion. And as their cloud business continues to grow alongside their other business segments and the stock price continues to fall, I will continue to buy more and more of it. Thanks for watching today's video, and I'll probably come out with another video going further into depth about Taiwan Semiconductor within the next week or two. So if you liked the video, please subscribe and have a good day.